Retail investors are entirely focused on the wrong metrics right now. They are staring at a boring, sideways chart, completely unaware that the largest structural shift in the history of decentralized finance is happening quietly in the background. What if I told you that the single greatest barrier to this asset's price appreciation was just legally dismantled by the United States government, while simultaneously the largest asset managers in Europe are hardwiring billions of dollars into its infrastructure? Right now, Chainlink is trading between $8 and $9, sitting on a macro support level that has historically preceded massive capital rotations. Most people are exhausted, calling the price action dead. But as sophisticated investors, we don't trade on emotion. We trade on asymmetric data. Today, we are going to look at the undeniable on-chain reality, the institutional monopolies being formed, and exactly how I'm positioning my own portfolio to capture the upside while strictly managing downside risk. The disconnect between the underlying network value and the token price has never been wider. Let us examine the data. Currently, the price of Chainlink sits heavily in the $8 to $9 range. If you look at social sentiment, it's completely washed out. The average market participant is bored, frustrated, and looking for immediate gratification in highly speculative, low-cap assets. But this is exactly where the wealth transfer occurs. We are presently operating in a macro environment where capital preservation and risk-adjusted returns must dictate your strategy. This video matters right now because we are at a definitive crossroads. Since my last update on March 11th, the price has remained pinned exactly inside my primary accumulation zone. To the untrained eye, this looks like dead money, but the on-chain metrics and fundamental catalysts tell a completely different story. There's a massive divergence unfolding. While retail capitulates, smart money is aggressively positioning. We are seeing a convergence of regulatory clarity, institutional product launches, and structural tokenomic shifts that are actively removing supply from the open market. But there is something in the technicals that changes this picture, a historical momentum setup that has previously yielded appreciations of over 150%. Before we look at the chart, we need to understand the fundamental forces that are going to drive the next major repricing event. Let us look at the hard facts. The most critical development for Chainlink, and perhaps for the entire utility token sector, is the recent joint interpretation issued by the United States Securities and Exchange Commission and the Commodity Futures Trading Commission. They have officially classified the Link token as a digital commodity. This is not just a headline, it's the holy grail for institutional capital. For years, the fear of Chainlink being labeled an unregistered security forced the development team to hold back on aggressive token value accrual mechanisms. As Bitwise Chief Investment Officer Matt Hogan recently explained, the previous regulatory regime made it illegal to have a direct economic tie to the token. Now that the commodity status is officially recognized, Chainlink Labs has the green light to execute its full economics roadmap. This paves the way for direct yield and fee sharing to token holders without the threat of enforcement action. Simultaneously, Chainlink is actively shaping the future of digital asset policy in the United States. Chainlink Labs and Anchorage have joined as founding members of the new Blockchain Leadership Fund. They are funding policy advocacy to build a compliant, regulated environment, effectively securing their market position from a legal standpoint. But regulatory clarity is only the foundation. The actual enterprise adoption we are seeing is staggering. Europe's largest asset manager, Amundi, which manages over 2.3 trillion euros alongside Spico, has launched a new tokenized mutual fund powered entirely by Chainlink infrastructure. They are launching with $100 million in committed assets under management. Traditional finance is not just experimenting anymore. They are moving massive capital on-chain, and they have chosen Chainlink as the verified standard for real-world asset tokenization. We are also seeing this expansion globally. The institutional-focused blockchain FinChain has adopted Chainlink to accelerate the distribution of tokenized assets across the rapidly growing Asian markets. In the decentralized finance sector, the dominance is absolute. Aave version 4 is now live, and they have selected Chainlink as their exclusive Oracle platform. Aave is the undisputed heavyweight in the lending space, with over $47 billion in net deposits. Securing exclusive rights here means Chainlink controls the data flow for the most critical credit markets in crypto. Furthermore, Aave has officially adopted Chainlink's smart value recapture on the Arbitrum and Base networks, which has already recaptured over $16.7 million in non-toxic liquidation miner extractable value. Chainlink is no longer just a data provider. It's an active revenue generator for protocols, which heavily incentivizes these networks to remain within the Chainlink ecosystem forever. This monopoly extends to the centralized exchange world as well. Coinbase has integrated Chainlink to bring its premium exchange data, which powers billions in trading volume, to blockchains for the first time. Moreover, Chainlink is now the exclusive bridging infrastructure for all Coinbase Wrapped Assets, a platform with over 100 million users and $500 billion in assets. Every time capital flows out of the largest regulated exchange in the United States, it uses Chainlink rails. Technologically, the network continues to innovate at a relentless pace. Development activity remains incredibly high, with Santiment reporting 245 dev commits in the last 30 days, making it a leader in the Ethereum ecosystem. They have also solved the latency issue that previously hindered high-frequency trading. The decentralized exchange GMX has launched ultra-fast perpetual markets on MegaETH, utilizing Chainlink data streams to support 10 millisecond block times. This proves the infrastructure can handle Wall Street-level speed without compromising decentralization. When you aggregate this dominance, the numbers speak for themselves. In terms of total value secured, Chainlink ranks first, with $39.8 billion across 496 protocols, capturing over 63% of the entire market. They have secured over 80% of the value on Ethereum, 96% on Base, 84% on Arbitrum, and 100% on MegaETH. This brings us to the tokenomics, which is where the investment thesis truly crystallizes. The protocol is generating massive cash flow. Over the last 180 days, Chainlink has generated $29 million in revenue from cross-chain interoperability protocol transaction fees and payment aggregator distributions. And what's happening to those fees? The Payment Abstraction Reserve has automatically bought 2.3 million Link, worth roughly $20 million, directly from the open market in just 7 months using enterprise fees. On top of that, the corporate treasury recently accumulated over 131,000 tokens in a single day, bringing their total holdings to nearly 2.8 million tokens. While this automated protocol buying is happening, institutional investment vehicles like the Grayscale and Bitwise trusts have posted 13 consecutive weeks of inflows with 0 outflow days. The spot products are showing persistent institutional buying, with cumulative net inflows reaching $98 million by today. Smart money is quietly front-running the retail market. There are now over 25,000 wallets holding at least 1,000 tokens, marking the highest level of whale accumulation since early December. The product is essential, handling trillions in value, and the token is finally proving its economic model. Trillions of dollars in assets rely on this infrastructure, and the underlying buy pressure is becoming structural. Now, let us look at how all of this fundamental weight translates to the weekly price chart. Looking at Link weekly chart, we need to start from a macro perspective to understand where we truly are in the market cycle. Right now, price action is hovering around that $8 to $9 mark. The most critical level to observe is our immediate support zone at exactly $8. This is not an arbitrary number. If you look closely at the chart, $8 perfectly aligns with the massive wick liquidation flush we saw back on October 10th. More importantly, this current support level was the heavy resistance ceiling throughout the prolonged 2022 and 2023 bear market accumulation phase. In technical analysis, former multi-year resistance turning into macro support is exactly the kind of market structure you want to see for a long-term bottom formation. Moving up from here, our immediate local resistance sits at $10. This is a psychological barrier in the top of our current consolidation box. Above that, the next major challenge is the $13 level. This $13 mark is incredibly significant because it perfectly aligns with the 236 Fibonacci retracement level. Let me explain the anchoring logic here. I have drawn this Fibonacci sequence starting from the macro lower high of $31 printed in December 2024, dragging it all the way down to our capitulation lows of $8, tested both in October 2025 and recently again in February. Breaking above that 236 fib level at $13.40 is the first technical requirement to suggest the macro downtrend is officially reversing. Further out, we are watching the 786 fib level at $26, which is the line in the sand to confirm a new higher high on the macro timeframe. However, the trend indicators currently show that we are still operating in a defensive posture. Price remains suppressed below both the 55 exponential moving average, represented by the purple line, and the 200 simple moving average, represented by the green line. Until we reclaim these moving averages on a weekly closing basis, the asset technically remains in a downtrend. Furthermore, we have a clear descending trend line, marked by the orange dotted line on the chart. This trend line originates from the August 2025 local top at $26. As price eventually begins to recover, this descending boundary will act as dynamic resistance, and breaking it will be a major technical event. But here's where the technical data becomes highly actionable. Look at the indicator at the bottom of the screen, the Heikin Ashi Relative Strength Index. 4 weeks ago, this momentum oscillator reached its most oversold reading in the entire history of the asset. We are now seeing the very early stages of a subtle bullish divergence forming. If the current weekly candle can close strong enough to engulf the price action of the previous week, this divergence will be confirmed. Notice the white circles I have annotated on both the indicator panel and the corresponding price action. In the past, whenever we reached these extreme oversold conditions on the weekly timeframe, it marked the exact bottom of the accumulation phase. Historically, these specific technical setups have preceded massive upward price expansions of at least 150%. We are staring at the exact same historical footprint right now. This brings me to my personal execution strategy. I operate strictly on predefined zones, removing all emotion from the trade. My primary load zone, indicated by the green box on the chart, spans from $7 up to $10. Because my view on this asset is fundamentally long-term, I'm slowly and methodically accumulating spot bags within this specific range. Yes, the price action is incredibly boring right now, but professional capital is deployed during periods of maximum apathy, not maximum euphoria. For my take-profit methodology, I have established clear, staggered targets, marked by the green circles. As price appreciates, I'll scale out portions of my position at $13, $16, $19, $22, $26, and finally holding a moonbag for the macro target of $45. By scaling out at predefined technical resistance levels, I'm actively booking yield and moving stops into profit to protect my initial capital. It's crucial to note my risk management parameters. While I have high conviction in the fundamentals, Chainlink represents a maximum of 3% of my total portfolio. Capital preservation comes first, which is why my main holdings, comprising roughly 65% of my net exposure, remain strictly in Bitcoin and Ethereum. When you synthesize the fundamental monopolies Chainlink is building with the heavily oversold technical structure, the risk-to-reward ratio heavily favors the patient investor. The worst-case scenario is that the broader macroeconomic environment continues to suppress all risk assets, causing Chainlink to linger in this $7 to $10 box for another 2 quarters. If we see a catastrophic breakdown below the $7 level, supported by heavy weekly volume, that would invalidate the current thesis, and I would be forced to reassess the structural integrity of the chart. However, the probability-based upside is compelling. The timeline here is not measured in days or weeks, but in months and quarters. We are waiting for the institutional capital currently flowing through regulated trust products to outweigh the exhausted retail selling pressure. Once the price reclaims the $10 level and pushes through the 55 exponential moving average, the technical momentum will naturally align with the fundamental reality. The thesis only changes if we see Tier 1 protocols migrating away from Chainlink infrastructure, but as the data clearly shows, the exact opposite is happening. Chainlink has achieved an undisputed monopoly over decentralized finance and real-world asset data bridging. The United States government has officially classified the asset as a commodity, removing the legal barriers to aggressive token value accrual, while the protocol itself is actively buying millions of dollars of its own supply off the open market. Technically, the asset is resting on macro historical support, with momentum indicators flashing extreme oversold signals that have historically preceded massive rallies. Remember, true wealth in these markets is generated by identifying fundamental value before the technical trend becomes obvious to the masses. Do not let boredom shake you out of a structurally sound position. If you found this data-driven approach valuable, please hit the like button and subscribe to the channel. It genuinely helps push this analysis to other serious investors. I highly recommend you go back and watch my previous video on Chainlink from March 11th, as the market structure we discussed there flows perfectly into today's thesis. Please remember that everything discussed is for educational purposes only and is not financial advice. Always manage your own risk. Finally, for those of you who want to take your market execution to the next level, I invite you to join the Pro Capital Vault on our private Discord. This is not a signal group. It's a professional environment where I share my real-time portfolio tracking, my exact limit orders for buy and sell zones, and host weekly live strategy calls every week to prepare for what's coming ahead. It's the logical next step for serious position traders who want to see the exact execution behind the analysis. Just click the join button below the video, scan the QR code, or use the link in the pinned comment to step into the war room. Once you join through YouTube, just sync your account to Discord to automatically unlock all the private channels. Much love for watching up to here. Stay disciplined, manage your risk, and I'll see you soon in the next deep analysis.